if you were to ask me 2 years ago when I was calling for inflation, would I expect it to be almost 8% officially? Probably not, right? So even as someone in the inflationary side, this has been a stronger inflation surge than I would have guessed. I've been on the inflationary side, but I've also been on the side that, we might start peaking by the second quarter, right? That, inflation might not normalize, but that it could kind of top out and chop around for a period of time. And the caveat that I say, okay, what is the risk that's not correct? What is the risk that inflation just keeps soaring higher? And it would be some sort of energy shortage, some sort of key thing like that. And so this war as a catalyst certainly adds fuel to the inflationary fire, right? So we already had inflation from money printing, from other shortages going into this, and now that you have an acceleration of commodity shortages and bifurcation of global supply chains, that should add further fuel to the inflationary fire. And so, it kind of remains to be seen how long this is going to go. But we start approaching more like the 70s at this point in terms of energy security and overall inflationary levels. And one thing I pointed out recently is that we have the most negative real yields on say short-term U.S. Treasuries since 1951. Right, so currency is getting devalued at a rate that has not been seen for quite a long time, and that's using the official numbers. So I think the official numbers. So next month, using that specific time frame, next month or two, I don't think you'll see a gigantic gap, because if you look at the way the calculation works, a very big chunk of it is actually home, right? So there's owner's equivalent rent, and things like healthcare, right? So those are unlikely to change rapidly in a month. If anything, we're seeing kind of home prices sort of kind of level out to some extent. They're cooling off compared to what they were doing over the past 2 years. And so there's a big chunk of the CPI index that won't change much. Now, the part that is going to change a lot is the food and the energy, right? So that's the part that's going to be, spiking up by double-digit percentages. And that's where everyone kind of has their own unique inflation basket. So the official CPI number, it'll be hot, but it might not be as high as you think. But then, for example, let's say your house is paid off and you have a pretty tight monthly budget. Maybe you're living on fixed income, for example. So obviously a big chunk of what you spend on goes towards food and energy. So someone in that situation, their effective inflation rate would be double digits. And so I think the quote unquote real numbers will be, at least in the low double digits. I wouldn't expect to see the official numbers show double digits right away. But if, the longer this goes on, you could hit double-digit official CPI in the U.S. So inflation's kind of an arbitrary basket. What they do is they kind of take a sample of what the average household uses. So what percentage of their expenses go towards housing? What percentage of their expenses go towards medical care? What expenses goes towards transportation? And they kind of formed this, this quote-unquote average basket, and then they track over time what happened to the inflation of that basket. But then it's further tricky, because instead of doing home prices, they do like owner's equivalent rent, and they also do hedonic adjustments. So they basically, if things get better over time, like if a car gets better than it was 5 years ago, even if the price doubles, they'll say, well, it kind of stayed the same, because sure, it doubled, but it got better. And they'll also do replacements. So for example, if a prime cut of meat goes up in price, they'll assume that you rotate it to a lower quality or lower price cut of meat. And so there are kind of ways to smooth out and lower that number compared to what, if you just look at a raw number, if you just kind of pick something like what are bacon prices doing over a long period of time, generally you'll see that prices like that are a little bit higher than what the CPI basket's saying, because you don't have those hedonic adjustments, you don't have those kind of replacement things kicking in. If you were to ask me 2 years ago when I was calling for inflation, would I expect it to be almost 8% officially? Probably not, right? So even as someone in the inflationary side, this has been a stronger inflation surge than I would have guessed. Obviously, war is adding to that now, but even before the war, this was already just in place. And so basically, when you have the combination of a rapid expansion in the money supply with various constraints. So supply chain constraints, commodity constraints, labor constraints, any sort of constraint, you're going to get price inflation. Another thing is that it can contribute to a recession because people have to spend more of their money on gasoline, on electricity, on food, and then therefore they can buy fewer iPhones. So they delay their phone upgrade cycle. They delay other purchases. They might skip a vacation, right? So if their necessary input costs go up, they have to cut down on discretionary costs. And so that's how you can get a recession. And that's why when you can have a stagflationary recession where commodity prices are high. Basically, the 70s would be a key example. So high commodity prices, but you'd go through periods of severe economic softness because people are getting squeezed in their pocketbooks. So the three closest decades would be the 2000s, the 1970s, and the 1940s. Those were generally the inflationary commodity boom decades. And obviously, they had very different magnitudes. So the 2000s were considered a rather favorable decade. And part of why you had a commodity boom is that you had the rise of the quote unquote BRIC nations, so Brazil, Russia, India, China. You had a dollar weakness, and so that contributed to an emerging market boom, and they had a rapid increase in their commodity consumption at a time when commodity supplies were rather constrained, and so you had a big uptick in commodity prices. But it was generally, for the most part, a good thing, right? It was kind of not that those price increases were good, but that it was happening for rather good reasons. A lot, the world was in some ways booming. Now that eventually turned into the subprime mortgage crisis, and that also, high oil prices contributed to the recession we eventually had in 2008. And so by the end of that period, it was negative. But overall, that's kind of in some cases the best example you can think of. The one prior to that, the big commodity boom before that, would be the 70s. And that's where you had severe supply constraints because the United States found oil in the kind of the second half of the 1800s. We had almost a century of just constant increase in our annual oil production. Occasional, you dip, but it was a structural increase. And that peaked in 1970. So in 1970, U.S. oil production peaked and started to roll over structurally. At the same time as baby boomers across the world, including the U.S., were coming into home buying years. And so you had basically a lot of commodity demand, and you had limited commodity supply. So the United States became more reliant on Middle Eastern oil. And so that opened up all sorts of geopolitical conflicts and shortages and inflation. And so that was a big issue. Now, that part of why we had low commodity prices recently is because the U.S.'s structural decline in energy production reversed because of shale.